The biggest market bubble might be the one you were told about. Here's the contradiction. You keep hearing that stocks are dangerously concentrated, wildly overvalued, and one headline away from collapse. But the actual data from 2025 tells a very different story. And if you're investing, saving, or even just watching your retirement account, this gap between narrative and reality matters directly to you. US stocks just finished 2025 with the S&P 500 up 17.9% and the Nasdaq 100 up 21.0%. That sounds like a bubble to some people. But here's the part that doesn't fit the fear narrative. Not a single S&P 500 sector finished the year in the red. Industrials rose 19.3%, utilities gained 16%, financials climbed 15%, healthcare added 14.6%. This wasn't a narrow, fragile rally breaking under its own weight. And yet, panic commentary keeps getting louder. That's the risk for you, not the market itself, but the information you consume about it. Because acting on the wrong story can cost more than a downturn ever would. But here's where this gets uncomfortable. One chart in this data set quietly dismantles the loudest market myth of the past 2 years. And once you see it, you can't unsee it. The core event isn't a crash, a spike, or a collapse. It's something far subtler. Over the past year, US equities didn't just rise, they spread out. Gains moved beyond the places everyone was watching. Yes, communication services jumped 33.6% and technology rose 24%. That's what made headlines. But underneath that surface, industrials, utilities, financials, and healthcare all posted double-digit gains. Even the so-called laggards like real estate at 3.1%, staples at 3.9%, and discretionary at 6.0% were still positive. That matters because bubbles don't usually look like this. They don't lift almost everything at once. Now here's the broader pattern most people missed. After 15 straight years of US dominance, international stocks surged 33% in 2025. That's not a rounding error. That's a regime shift beginning to form. And it didn't happen in isolation. The US dollar weakened by nearly 10%, while global trading partners began repatriating capital, signaling dissatisfaction with US trade and security policies. So the question isn't, are stocks expensive? The better question is why capital is suddenly spreading out instead of piling into the same few names. Because when markets broaden instead of narrowing, they usually aren't at the end of something. They're in the middle of it. But here's the part nobody is saying out loud. The most feared group in the market may no longer be driving it at all. Here's the claim that changes how you read everything else. Market concentration didn't explode in 2025. It quietly cracked. The most surprising chart in this entire dataset shows that only 2 of the so-called Magnificent Seven actually outperformed the S&P 500. 2. That means 5 of the 7 most feared, most discussed, most blamed stocks underperformed the index's 17.9% gain. After months of warnings that these companies would drag the market down, the opposite signal appeared. And think about what that implies. If 5 of the 7 largest names lagged, yet the index still climbed nearly 18%, then something else had to be pulling weight. That something was the other 493 companies. Price appreciation didn't collapse. It redistributed. This is where the narrative starts to wobble. The concentration bears warned that dominance would only intensify, but the data shows the dominance loosening, not tightening. That suggests earnings growth and capital flow are spreading outward, not compressing inward. Now notice what's missing from the loudest warnings. There's no evidence here of index fragility, no sector imploding, no collapse driven by overexposure to a handful of names. The fear was specific, the reality was broader. And once you see that, the next question becomes unavoidable. If this isn't a concentration bubble, then what kind of market are we actually in? Now watch how this escalates. because this is where most bubble arguments usually find their proof. Valuations. That's where excess tends to show itself first. Except this time it didn't. Over the past 5 years, price-to-earnings multiples stayed mostly flat. Not compressed, not exploding. Flat. That's a sharp contrast to the late 1990s when valuations stretched higher quarter after quarter with no pause. And when you zoom in on the companies most often accused of fueling a bubble, the picture gets even more awkward for the panic narrative. Forward PE ratios for core AI-linked companies like Meta, Google, Amazon, and Microsoft either stayed stable or declined. These aren't obscure footnotes. These are the exact firms people point to when they say, this feels like 1999, but in 1999, multiples were expanding aggressively even as fundamentals lagged. Here, the multiples aren't doing the work. This is where the story flips. Markets can rise for bad reasons or good ones. Rising prices driven by multiple expansion are fragile. Rising prices supported by earnings are not. And the absence of valuation blowout removes one of the classic warning signs investors are trained to fear. But here's the detail that changes everything. If valuations aren't stretching, then something else must be doing the heavy lifting. And that takes us to the fuel that usually turns rallies into disasters. This is where bubbles usually reveal themselves, not in prices, but in leverage. Excess debt, borrowed money pushing risk higher than reality can support, and that's exactly where this cycle refuses to cooperate with the fear narrative. Debt growth in 2025 increased by just 9%. Read that again, 9%. Compare that to the late 1990s when debt exploded in consecutive years by 111%, 152%, and then 187%. Those weren't expansions, those were accelerants. That's what turned speculation into systemic risk. Here, debt stayed essentially flat for 5 years before that modest uptick. No surge, no leverage spiral, no desperation borrowing to chase returns. That's a direct contradiction to the idea that this market is being held together by financial engineering. This is the line that permanently changes how you see this cycle. Bubbles don't form when investors are cautious. They form when restraint disappears. And restraint is exactly what this data shows. Now notice what this quietly exposes. The loudest bubble warnings rely on vibes, not balance sheets. They talk about excitement, headlines, and narratives, but the traditional accelerants of collapse simply aren't present at scale. And if leverage isn't driving this market, then one final question matters more than all the rest. What's actually paying for these prices? Here's where the pressure starts stacking fast. Earnings didn't stall, they accelerated. Over the past few years, earnings growth stayed strong, providing real support beneath rising prices. That alone separates this moment from the dot-com era where profits lagged while valuations raced ahead. This time the fundamentals moved first. Now add the second development, the AI boom, which many dismissed as pure speculation, produced tangible business results. These weren't concept demos or future promises. Companies integrated AI directly into core operations. Google is the cleanest example. Despite repeated predictions that AI would destroy its core search business, Google integrated AI into search and its stock rose 65% in 2025. Then comes the third pressure point. While US earnings remained solid, capital began flowing outward globally. International equities rose 33% in 2025 as the dollar weakened nearly 10%. That combination suggests investors weren't panicking. They were reallocating, seeking value, and spreading exposure. This is what momentum without mania looks like. Growth followed by validation, followed by redistribution. But here's the uncomfortable question that follows naturally. If earnings keep supporting prices, if leverage stays muted, and if capital keeps rotating instead of collapsing, what happens if this continues? Now bring this down to where it hits you. because this isn't about charts on a screen. It's about behavior. When markets are labeled bubbles, people don't just get cautious. They freeze. They stop investing. They pull back contributions. They sit in cash waiting for a crash that never quite arrives. And the cost of that hesitation compounds quietly. Think about what 2025 actually looked like in real life. Nearly every sector moved higher. Earnings grew. International markets finally joined the rally. Yet many investors stayed on the sidelines because the noise told them danger was imminent. That gap between perception and reality isn't theoretical. It shows up in missed gains, delayed retirement timelines, and portfolios that never fully recover from early exits. This is where ideology drops out of the picture. No politics, no narratives, just math. Markets don't need euphoria to rise. They just need businesses to keep earning money and capital to keep flowing. And that's exactly what happened while fear dominated the conversation. Here's the subtle damage. When people consume constant warnings, they don't feel cautious, they feel responsible. But responsibility, when driven by misinformation, quietly becomes risk in disguise. If this feels familiar, say so in the comments, because what comes next explains why this pattern keeps repeating, even when the data keeps disagreeing. This keeps happening because of how the system rewards attention, not accuracy. Market fear spreads faster than market data. Warnings travel better than nuance. A headline claiming bubble triggers urgency. A chart showing flat valuations does not. That imbalance creates an incentive structure where the most confident-sounding prediction wins, even when it's unsupported. Here's the mechanism. Information ecosystems reward speed, certainty, and emotional clarity. Saying this is complex and still evolving doesn't travel. Saying this will end badly does. Over time, that skews perception, making normal market behavior feel abnormal and stability feel suspicious. Meanwhile, disciplined processes get drowned out. Data-driven analysis requires context. Context requires time. And time is the one thing attention economies don't allow. So investors are fed fragments instead of frameworks. This is why fear can persist even when leverage is low, valuations are flat, and earnings are rising. The system isn't built to update beliefs, it's built to reinforce them. And once you understand that, a more unsettling realization follows. If narratives lag reality, then the biggest risks and opportunities tend to arrive quietly before anyone is emotionally prepared, which brings us to the next move that's already forming. We're now at the point where the future forks, and neither path looks like the story most people are expecting. On one path, earnings continue to do the work, not spectacularly, not explosively, just steadily. Capital keeps rotating instead of rushing. International markets keep absorbing flows as the dollar stays weaker. In that scenario, volatility shows up, but it doesn't break the structure. Markets move sideways at times, then higher, frustrating both the crash callers and the euphoria chasers. On the other path, the risk isn't a classic bubble pop. It's something slower, a narrative-driven mistake. Investors, overwhelmed by constant warnings, underallocate for too long, cash builds up, participation thins, and when growth persists anyway, re-entry happens late, at worse prices, with more stress and less margin for error. Notice what's missing from both paths: a sudden collapse driven by leverage, valuation blowouts, or earnings failure. Those are the ingredients history usually demands, and they aren't present in the data you've seen. This is why the next move won't announce itself. It won't come with sirens. It'll come disguised as boredom, doubt, and disbelief. And that sets up the final question that matters most. What story are you letting guide your decisions? Here's the insight that ties all of this together. Markets don't usually punish optimism, they punish confusion. When investors mistake noise for signals, They exit strong trends early and enter them late. And the most dangerous bubbles aren't always in prices. They're in beliefs. 2025 wasn't defined by excess. It was defined by contradiction. Broad gains without leverage. Stable valuations with rising earnings. Fading concentration alongside global rotation. That combination doesn't scream collapse. It whispers transition. Reframe the entire story in one sentence. This wasn't a market floating on hype. It was a market climbing while being doubted. And that doubt is the loop, because the same forces distorting today's narrative are already shaping the next one. Another sector, another theme, another warning cycle that will sound urgent and feel responsible. If you want to stay ahead of that loop, follow and subscribe. Not for predictions, but for analysis grounded in data, context, and calm thinking. Because the most important moves in markets rarely happen when everyone is looking